Welcome back to Talk Tickers, the deep dive where we break down corporate earnings calls so you, the retail investor, can actually understand what's happening behind the curtain.
Right. Our mission is to take all that dense Wall Street jargon and translate it into plain, actionable language.
Exactly. And today we have a really fascinating one. We are unpacking the Q3 2026 earnings call for Zscaler.
Ticker symbol ZS.
Yes, and this particular call is honestly one of the most contradictory readouts we've seen in a long time.
Contradictory is like the perfect word for it because, Zscaler just posted one of the most staggering, highly profitable, hyper growth quarters in the entire history of enterprise cybersecurity.
They absolutely crushed it on paper.
Right. They're practically swimming in cash. They're closing these massive 8-figure deals left and right. But then, and this is the crazy part, on the exact same call where they announced these blockbuster numbers, management sounded terrified.
Yeah, they issued an incredibly cautious outlook for the next 12 months, which, as you might expect, completely spooked Wall Street. It sent analysts into an absolute panic. So today, we are going to decode these financial contradictions. We'll explore the mechanics of these autonomous AI agents that are currently hunting corporate networks.
And we'll dig into the internal sales machinery that caused this sudden shift in their forward outlook.
Because if you are holding this stock, or if you're thinking about buying in, you need to know if this is a bullish opportunity or a massive bearish warning sign. So let's start with part one of our Talk Tickers format, the headline numbers.
Let's do it. And the baseline here is just how massive this operation has become. The raw data from Q3 paints a picture of a company operating at an elite level.
Yeah, revenue hit $850 million for the quarter.
Which is a 25% growth rate year over year. That beat the high end of their own guidance.
And their annual recurring revenue, their ARR, reached $3.5 billion, also up 25%.
Right. A 25% growth rate at a $3.5 billion scale is, well, it's incredibly difficult to pull off.
It's massive. But here's the thing that really stood out to me when I was looking through the transcript. Usually when you see a software as a service company putting up those kinds of hyper-growth numbers, they are just burning cash like crazy.
Oh, absolutely. The classic SaaS model is, spend $2 on marketing just to acquire $1 of revenue.
Exactly. But Zscaler's profitability metrics completely defy that stereotype.
They do. And this is crucial for you to understand when you're evaluating their market position. They aren't just buying growth at any cost. Their non-GAAP operating margin hit an all-time high of 23%.
Wow.
Yeah, that's up 140 basis points from last year. And it translates to an operating income of $196 million.
That is a lot of cash.
And their actual cash generation is even stronger. They generated $198 million in operating cash flow just in Q3.
Right, which brings their year-to-date free cash flow margin to 29%, I think.
29%, exactly.
So let's translate that for you, the listener. A 29% free cash flow margin means that for every single dollar coming into the business, almost 30 cents drops straight to the bottom line as pure, unencumbered cash.
It's a highly lucrative model, and they're driving this by embedding themselves deeply into the Fortune 500. They closed the quarter with 748 customers that generate over $1 million in ARR each.
That's an 18% growth in just that $1 million plus cohort alone.
Right. They are successfully moving up market.
Okay, so I see the 25% growth plastered all over the press release. I see the 29% cash flow margin. But I have to play the skeptic here for a minute.
Go for it.
Because when you actually dig deep into the transcript, and this is why we do these deep dives, the CFO, Kevin Rubin, casually mentioned something really interesting.
The Red Canary acquisition.
Yes.
Okay.
They recently bought a cybersecurity firm called Red Canary. And the CFO mentions that Red Canary exited Q3 with $127 million of ARR. So if we strip out that purchased revenue, their organic net new recurring revenue only grew by 14%.
That's true.
14% is a far cry from the 25% headline number they're bragging about. So my question to you is, are they just using these massive acquisitions to mask a fundamental slowdown in their core business?
That is exactly the discrepancy Wall Street analysts look for. You always have to parse out organic versus inorganic growth when a company is touting record numbers. But calling a 14% organic net new growth rate a failure, That ignores the reality of scale.
How so?
Well, maintaining hyper-growth percentages mathematically degrades as your base revenue expands into the billions. It's the law of large numbers.
Fair enough.
But more importantly, the source material emphasizes their performance against the rule of 55.
Okay, hold on. Rule of 55. In the software industry, you usually hear investors talk about the rule of 40, right?
Exactly. The rule of 40 is the traditional gold standard for SaaS businesses. It says that a software company's revenue growth rate plus its free cash flow margin should equal 40% or higher.
So it's a metric that balances the trade-off between growth and profitability.
Right. If you're growing at 30%, a 10% profit margin is fine. If you're only growing at 10%, you need a 30% margin to be considered a healthy business.
Okay, but Zscaler is operating at a rule of 55.
Precisely. Which means their combined growth and profitability are shattering the industry benchmark.
So for you as an investor, this proves they aren't just engaging in some desperate M&A roll-up strategy to fool the market.
No, not at all. They successfully absorbed a massive strategic acquisition like Red Canary, while their core machine pumps out cash at an elite rate. It shows highly disciplined, profitable scaling.
Okay, so the financial foundation is rock solid. That brings us to part 2 of our format, the story behind the numbers. Why are these massive corporations suddenly throwing millions of dollars at Zscaler in 2026?
That requires us to look at the current threat landscape. And the core thesis driving this massive revenue surge comes straight from CEO Jay Chowdhury on the earnings call.
Yeah, I saw his quote. It honestly felt like a dispatch from a dystopian sci-fi movie.
He stated very plainly that AI agents will soon become the absolute weakest link in global cybersecurity.
Which is a huge shift, right? For the last 20 years, the biggest threat to a corporate network was human error.
Exactly. It was John in accounting falling for a phishing email or someone reusing a terrible password like password 123.
Right. But now we've entered a completely new paradigm of offensive cyber operations.
Enterprises are facing what the industry calls frontier models. And on the call, the CEO specifically highlighted a new model named METOS. METOS.
Right, METOS. And these aren't just traditional computer viruses or malware, are they?
No. These are incredibly sophisticated AI systems that actively hunt for software vulnerabilities at what Chowdhury calls machine speed.
Okay, let's unpack machine speed for a second, because this is the entire reason these enterprise CSOs are panicking. It doesn't mean a human hacker typing really, really fast in a dark hoodie.
Not at all.
It means an algorithm that continuously monitors newly disclosed software vulnerabilities across the entire globe.
Instantly.
And then it reverse engineers the patch differences to figure out how the exploit works and concurrently sprays custom payloads across millions of IP addresses.
While simultaneously brute forcing logic flaws in corporate APIs, all without human intervention.
It's terrifying.
It completely breaks traditional defense mechanisms. The CEO noted that these frontier models are effectively multiplying the number of unremediated vulnerabilities within an enterprise by a factor of 10.
Wow, 10 times.
Think about it. Every large corporation already has thousands of known security holes. The IT teams just don't have the time or budget to patch them all.
Right, they have to prioritize the critical ones.
Exactly. But now, AI is actively finding and exploiting all those ignored holes 10 times faster. It is mathematically impossible for a human team to patch systems fast enough to outpace an AI agent hunting at machine speed.
So the old way of doing things is dead. The traditional corporate firewall is obsolete.
It has to be. To grasp why the market is shifting so rapidly to Zscaler, you need to understand the architectural difference between a traditional firewall and Zscaler's Zero Trust Exchange.
Right. Let's break that down in plain language.
A traditional firewall is built on the concept of a trusted internal network. It's a perimeter defense.
So think of a traditional firewall like an office building with a really tough bouncer at the front door.
That's a great analogy.
The bouncer checks your ID, makes sure you're on the guest list, and then lets you inside. But here's the flaw. Once you show a fake ID or sneak past that bouncer, you are in the lobby.
And you have full access.
Right. You can take the elevator to any floor, walk down any hallway, open any unlocked desk drawer. Once you breach that perimeter, the internal network just inherently trusts you.
And that implicit trust is what enables lateral movement. Lateral movement is the exact mechanism by which almost all modern ransomware attacks operate.
Meaning the attacker doesn't just break in and stay in one spot.
Exactly. The attacker, whether it's a human or an AI agent like METOS, they gain a tiny, seemingly insignificant foothold, like compromising one smart thermostat or one low-level employee's laptop.
Just to get past the bouncer.
Yes. And from that single point, they roam freely across the trusted network. They map the architecture, escalate their privileges, and move laterally until they find the databases holding the company's most sensitive information.
But Zscaler's Zero Trust Exchange completely abandons that whole front door concept.
Complete.
Instead of an office building with a bouncer, Zscaler acts more like an invisible bunker with a blind switchboard operator.
The user and the application are entirely isolated from each other.
Right, so when a user needs to access an application, they call the switchboard operator. The operator verifies exactly who they are, verifies the context, and securely wires them directly to that one specific application.
Just for that one specific session.
And then it unplugs the connection the second they are done. The user never actually joins the corporate network.
They never even see the internal hallways. And furthermore, Zscaler utilizes outbound-only connections.
Which means the applications are hidden from the internet entirely.
Exactly. As the CEO remarked on the call, an attacker cannot breach what they cannot reach. You can't exploit a vulnerability in a server if your automated scanning tools can't even detect that the server exists in the first place.
That is so wild. If Mitos is finding holes 10 times faster than you can patch them, you literally have to stop playing whack-a-mole with patches. You just have to eliminate the attack surface.
You hide everything. If Mitos compromises that one employee's laptop, it's trapped. There's no network for it to scan.
Okay, but executing that invisible switchboard strategy requires a massive amount of infrastructure, right?
A staggering amount. The transcript highlights that Zscaler's Zero Trust Exchange spans 160 public data centers.
160.
And it processes more than 500 billion transactions a day.
500 billion transactions every single day.
The telemetry data generated by that kind of scale is their true competitive moat. When you process 500 billion transactions daily, you possess an unparalleled data set of what normal human network traffic looks like versus what a hyperspeed AI attack looks like.
So they use that data to train their own defenses?
Yes. They feed that massive stream of raw data back into their own algorithms. They're constantly training their systems to intercept new threat patterns before they even reach the customer.
Okay, so the invisible switchboard keeps the external attackers out. That solves the perimeter problem. But, and this was the part of the transcript that really made me pause to it, the CEO pointed out that companies aren't just fighting external AI.
Like the internal threat.
Yeah. They are actively inviting AI agents inside their own organizations to automate workflows and analyze data.
Which introduces a massive internal blind spot.
It's like inviting the vampire in. If an enterprise grants an autonomous AI agent access to mission-critical applications, and that internal agent is somehow compromised, like through a prompt injection, the consequences are severe.
A prompt injection, for those who might not know, is essentially tricking the AI into ignoring its original instructions and executing malicious commands instead.
Right. And the CEO noted that a compromised internal AI agent can move from initial discovery to massive data theft in a matter of minutes, because it's operating at machine speed autonomously with no human oversight.
So now you have a situation where invisible automated software is running wild inside your invisible network infrastructure.
Exactly. How does an IT department even begin to track what these agents are doing?
That massive visibility gap is precisely why Zscaler had to act aggressively in the M&A market. Just days before this earnings call, they announced their intent to acquire a company called Symmetry Systems.
Symmetry Systems. So why did they buy them? What does Symmetry do that Zscaler's army of engineers couldn't just build themselves?
Symmetry Systems solves a highly complex, uniquely modern problem: AI identity management. It is fundamentally different from traditional human ID and access management, or IAM.
Right, let's contrast those two, because this is central to where the whole industry is heading. With a human employee, tracking access is pretty straightforward.
Sure. John from marketing logs in.
Yeah, John logs into his laptop using Okta or Active Directory. He has a set username, a password, maybe a multi-factor prompt on his phone. The system knows who he is, what department he's in, and what files he can open. There's a clear, persistent identity trail.
But AI identities do not behave that way at all. They are fluid, dynamic, and highly ephemeral.
Ephemeral, meaning they don't last long.
Right. For example, AWS or Azure might spin up a serverless Lambda function to perform a specific data transformation. That function requests a temporary access token, reaches into a storage bucket, mutates a massive data set, and then literally terminates itself 2.3 seconds later.
And a traditional identity logging system completely misses that event.
Entirely.
Yeah.
Because it's looking for John from marketing logging in at 9 a.m. It's not looking for a nameless algorithm that lived and died in 2 seconds.
So tracking which machine identities are communicating with which data sources across a multi-cloud enterprise is just a logistical nightmare.
It is. But Symmetry Systems tackles this by pulling raw information directly from application logs and cloud telemetry. They use it to dynamically create what they call an excess graph.
An excess graph.
Think of it as a real-time, highly granular visual map of how every single identity, human or machine, connects to every single data source across the entire enterprise.
Okay, so by acquiring Symmetry, Zscaler isn't just buying a mapping tool. They are plugging that excess graph directly into the core of their Zero Trust Exchange.
Exactly. So now the switchport operator doesn't just verify human users. It enforces granular policies on the AI agents themselves. It can track exactly what data the agent touches, ensure it only accesses the specific databases it needs, and instantly kill the connection if the agent starts acting weird.
It's a masterful acquisition. It immediately addresses the exact vulnerability these CISOs are freaking out about. And they're pairing this with some really high-level strategic partnerships, too.
Yes, the earnings transcript highlighted partnerships with Anthropic on Project Glasswing and with OpenAI on their Daybreak program.
OpenAI's Daybreak program is fascinating. The mechanics of this mean that Zscaler gets early, privileged access to the absolute newest, most dangerous frontier models before they are released to the public.
It creates a vital feedback loop. If adversaries are using frontier models to uncover zero-day vulnerabilities, Zscaler needs those exact same algorithmic capabilities to attack their own systems first.
Right. They relentlessly red team their own infrastructure. They find the flaws and patch them before the bad guys even know they exist.
So their product suite is essentially science fiction turned reality. They hide global networks, map AI neural pathways in real time, and partner with the biggest AI labs on the planet.
But having the best tech in the world is only half the battle. You still have to convince massive, bureaucratic, slow-moving corporations to actually buy it.
And this is where the transcript reveals the sheer effectiveness of their go-to-market strategy. They've engineered a sales mechanism called ZFLEX pricing.
ZFLEX.
The financial results of this program are staggering. ZFLEX generated $480 million in total contract value, or TCV, in the third quarter alone.
Wow.
And over the trailing 12 months, it has delivered over $1 billion in TCV.
So let's talk about the mechanics of ZFLEX, because it reveals a deep understanding of corporate psychology and bureaucratic friction.
It really does.
The pitch they make to a CISO is basically this: sign a multi-year, high-value commitment with us, and we will give you a universal tier of credits. You can swap different Zscaler modules, in and out, turn on data protection, launch a new AI defense module without ever starting a new procurement cycle.
They sell it as ultimate flexibility for an unpredictable world. And the CFO noted the average ZFLEX contract term is 4 years.
Right. They are securing massive long-term capital commitments. But let's look at the underlying reality here, because I pushed back on this when I read it. This isn't just about flexibility. It is a brilliant, almost insidious mechanism for ultimate vendor lock-in.
Oh, absolutely.
If you've ever worked in corporate IT, you know the absolute worst part of adopting new software is the procurement process. The friction is immense.
Issuing an RFP, evaluating vendors, legal reviews, InfoSec assessments, it can take 9 months just to buy one software tool.
Exactly. ZFLEX completely bypasses that nightmare. By getting the enterprise to sign a massive master service agreement up front, Zscaler removes all the friction. When a CISO suddenly needs a new tool to track prompt injections, they don't have to go beg the finance department for a new budget.
They just click a button in the dashboard, provision the new module, and consume their existing ZFLEX credits.
Right. And human nature dictates that once you're inside an ecosystem that's frictionless, you never look at a competitor again. The barrier to trying a rival product is 6 months of red tape. The barrier to buying more Zscaler is 1 click. It's a highly lucrative trap.
And the transcript provides concrete evidence of how well this land and expand strategy works. Management highlighted a major deal with a Fortune 500 finance company. This client initially signed a 5-year, 8-figure ZFLEX contract.
Okay.
Because of that frictionless structure, they almost immediately increased their ARR spend with Zscaler by 50%, adopting 6 new product modules simultaneously.
And one of the key modules driving those upsells is their new AI Protect suite, which they just introduced in January.
Right. designed to set guardrails on AI tools.
And by leveraging ZFLEX, they pushed AI Protect across the $100 million booking threshold in less than 12 months. They bypassed the traditional sales cycle entirely.
But their momentum isn't just software upsells. They are aggressively targeting legacy hardware incumbents too. The transcript details a deal with a leading national healthcare system. It was the largest zero-trust branch deployment in the company's history. An 8-figure deal covering 2,000 physical clinic locations.
2,000 locations. And they went in and entirely ripped out the legacy firewall vendor and the antiquated VPN infrastructure.
They implemented the invisible switchboard model, added advanced AI protections, and they did it all at roughly half the total cost of the legacy hardware solution.
I mean, that's an offer you can't refuse. We'll modernize your security and slash your budget by 50%.
And they're accelerating this through cloud marketplaces too, transacting $900 million in TCV year-to-date through AWS and Azure.
Right, because massive enterprises sign billion-dollar cloud consumption commitments with Amazon or Microsoft. If they don't spend it, they lose it.
Yeah.
Buying Zscaler through AWS counts against that required spend. It removes even more friction.
Exactly. So to summarize the narrative up to this point, flawless financial metrics, highly profitable organic growth, a product perfectly positioned for the AI threat, and a frictionless sales mechanism.
On paper, they seem totally unstoppable. But this brings us to part 3 of our Talk Tickers format, management guidance. Because, despite all this perfection, a severe macroeconomic reality is hitting them hard.
Right. The boom in artificial intelligence is a profound double-edged sword for Zscaler. It drives unprecedented customer demand for their software, but building the infrastructure to run those AI models requires physical hardware.
And the global strain on the hardware supply chain is creating a massive financial headwind. It's easy to forget that Zscaler relies heavily on a massive physical footprint.
500 billion daily network transactions require vast data centers globally, and those physical zero-trust branch deployments require proprietary hardware appliances installed on-site.
And what do you need to build those? Memory, high-speed storage, and advanced processors. The exact same components that Microsoft, Google, and Meta are currently fighting a literal bloodbath over to build their AI data centers.
The competition has distorted the entire semiconductor market. CFO Kevin Rubin explicitly warned that component prices are rising significantly and availability is severely constrained.
So what's their tactical response? They hoard. The CFO admitted they are actively pulling forward their capital expenditures, their CapEx, from fiscal year 2027 into the fourth quarter of fiscal 26.
They are opportunistically buying up data center equipment just to lock in today's prices before the market skyrockets further.
And this has a direct negative impact on their short-term financials. Because they are pulling forward these massive hardware purchases, their FY26 CapEx will hit the high single digits as a percentage of total revenue.
Which is a big jump from their prior expectation of mid-single digits. But what really caught analysts' attention was the projection for the following year.
Yeah, FY27.
The CFO stated that in FY27, CapEx as a percentage of revenue will increase by up to 200 basis points compared to the elevated FY26 levels.
That is a massive reallocation of capital. Hundreds of millions of dollars diverted away from free cash flow and basically parked in warehouses as servers.
It raises a critical question about sustainability. Are they just going to keep passing these escalating hardware costs directly onto the customer?
Well, the CFO did mention they quietly pushed through a price increase on their branch appliances earlier this year. But if the whole tech sector is bidding up processor prices, at what point does the enterprise customer refuse another price hike?
During the Q&A, an analyst from BNP Paribas aggressively pressed management on this. He asked point blank if they intended to raise hardware prices again next year.
And what did the CFO say?
He was noticeably non-committal. He just said they review pricing continuously and haven't seen significant blowback yet. CEO Jay Chowdhury jumped in to emphasize that this is an unprecedented macro environment.
The implication being that customers know there's a hardware shortage and the software protection is so valuable, they'll just absorb the cost? For now.
For now, yes. But if component prices continue to spike unabated, it will inevitably compress that incredible 29% free cash flow margin.
The hardware issue is a dark cloud for sure, but honestly, that was just the preamble.
It was.
The absolute bombshell dropped by the CFO, the thing that derailed the whole triumphant narrative, was about human capital, specifically sales leadership.
Right at the end of Q3, Two highly critical sales leaders operating directly under the chief revenue officer, Mike Rich, departed the company.
And the timing could not possibly be worse. They're trying to capture the AI market, integrate Red Canary, and fend off legacy vendors. And right in the middle of this complex maneuver, they suffer a massive leadership vacuum in the exact department responsible for closing these 8-figure deals.
Management tried to calm everyone down by saying one spot was filled internally and the other is in late-stage hiring. But the damage to the projections was done. Because of this disruption, the CFO announced a heavily, quote, prudent approach to forward guidance.
And if you're an investor, you know that prudent is Wall Street code for highly conservative and basically terrified.
Right. And the numbers were very conservative. For Q4, they guided roughly 22% revenue growth. A slight deceleration, but still strong.
But then they gave an early look into fiscal year 2027, and they projected that total ARR and revenue growth will slow down dramatically, settling into a range between 16 and 17%.
Dropping from 25% growth down to 16% is a jarring deceleration for a stock trading at a premium valuation.
Yeah.
And the root cause isn't just two sales guys leaving. Management openly admitted they are struggling with new logos.
Acquiring new customers.
Yes. The CEO stated they currently serve roughly 4,500 enterprise customers, but their total target market is 20,000 large enterprises.
So they only have 23% penetration. And they are really struggling in the lower end of the enterprise market companies with 2,000 to 10,000 employees.
To fix this, Jay Chowdhury laid out a 4-point plan. First, expand sales coverage in that lower enterprise market. Second, heavily incentivize the VAR channel value-added resellers to hunt for mid-tier logos.
Third, deepen partnerships with global system integrators, the massive consulting firms, through Project AI Guardian.
And fourth, restructure internal teams to focus solely on major accounts, forcing the sales team to hunt for net new business instead of just upselling ZFLEX to existing clients.
It's a logical plan, but I have to push back here. Let me play devil's advocate. Are we really supposed to believe that a massive drop in global revenue forecast is just because of a temporary sales leadership gap? They only have 23% of the market. Isn't it possible that the easy sales are just done?
The analysts pursued this exact line of questioning. Analysts like Brad Zelnick and Joshua Tilton pressed management repeatedly. The core question was, if CSOs are so terrified of AI threats, why is your growth rate decelerating?
Exactly. If Mitos is hunting my network at machine speed, I'm buying Zscaler tomorrow. Why is growth dropping to 16%?
Because enterprise sales cycles operate independently of technical urgency. Moving from a legacy firewall to zero trust isn't a software patch. It is a massive disruptive architectural shift.
You have to map every app, define access policies for every user, rip out physical hardware in 2,000 branches. It requires C-suite buy-in and months of labor.
It takes immense time to navigate, especially when selling to the hyper-conservative, risk-averse segment of the market that Zscaler now has to target. And on top of that, they baked a slower-than-expected uptake of the Red Canary SecOps integration into the FY27 numbers.
So synthesizing all this brings us to part 4. The bottom line. It's a confluence of friction. You have the friction of convincing legacy corporations to execute a massive architectural shift, the friction of cross-selling a new acquisition, the macro friction of rising hardware costs, and a sudden leadership vacuum in the sales department.
When you face that, you issue a conservative guide of 16%, rather than over-promising 25% and missing the mark.
So the bottom line for investors, the tech is flawless. They have the absolute right product for the AI era, but they are entering a highly treacherous operational transition period. The era of easy, frictionless sales is over. Now they actually have to execute the hard part.
It's a high-stakes balancing act. They built the impenetrable bunker. Now they have to convince the remaining 15,000 global enterprises to abandon their familiar castles.
Well said. We want to thank you for joining us on this deep dive. Hopefully, we helped translate the Wall Street spin into actual actionable insight.
Before we go, I want to leave you with a lingering thought built on today's material. Jay Chowdhury noted that frontier models like Mitos are hunting vulnerabilities at machine speed. In response, Zscaler is deploying AI agents to defend at machine speed.
The speed of the conflict has surpassed human capability.
Precisely. So it raises a profound question for you to mull over. Are we rapidly approaching a future where enterprise cybersecurity is no longer a human endeavor, but just a silent, high-speed war between opposing algorithms, leaving human IT teams as nothing more than anxious spectators whose only real job is paying the server bills.
I mean, honestly, that sounds incredibly likely. We will leave you to ponder that one. Thanks for diving deep with us.